Right. Okay, Lama. Sandhi live there. Good morning. Sorry for the inconvenience. There's a problem in my. Okay, Lama. Sandhi live there. Shall we start with the? Okay, right. Market structures. Alana, are you okay right now? I mean, are you okay? Are you well now?
Yes,
Fever,
well,
that viral fever.
uh,
No?
not that kind of one, sir.
Right. Okay, Lama. Last day we started market structure lesson. Market structures. Market structures. You know, right. Market structures. Right. Last day we started market structures, Lamai. All markets in economy Buddha can be classified into four different, categories. Right. When categorizing these market structures, Lamai, when categorizing all these markets into four structures, we use four main dimensions. Right. Four main elements when classifying market structures. These are common elements of every market structure, right? Based on these main characteristics, main dimensions, Lamai, we can identify some market structures. Actually, there are four market structures, right? These are the main dimensions of classifying market structures. Can you tell me, Buddha? Can we recall? What is
Number
number
of
one?
firms.
Yes, number of firms, right? Every market has number of firms, but different. In some market, entire market, is dominated by one firm, right? In some markets, few. Other markets, the large number of sellers, right? Second one is nature of the product. Third one, barriers to entry and exit, nature of barriers. Third one, Buddha, the nature of information, whether perfect information available or not. Based on these four main characteristics, Buddha, we can identify four main market structures in your syllabus. What are the market structures? Perfectly competitive market, monopoly market, monopolistic competition, and oligopoly market. These are the four market structures. Okay. Today, Buddha, I'm going to start first market structure, perfectly competitive market structure. Okay, Lama. Right. First one. Buddha, come to the page number 2, no 4. Page number 4. Look at page number 4. Look at page number 4. This one. Perfectly competitive markets, defining defining characteristics. Defining characteristic is mean to the main characteristics of perfectly competitive market or assumptions. Buddha, here I have purposely put this topic assumptions, main characteristics or assumptions. The reason is, Lamai, in the real world, practically, it's very difficult to find examples for perfectly competitive market, right? It's difficult to find perfect examples for perfect competition market, right? I mean 100% Okay, market structure where the perfectly competitive market where all conditions and all characteristics fulfilled. It's very difficult to find perfect example for perfectly competitive market. That's why I have put this word with the assumptions, right? Assumptions. Okay, the lamai, right? Now remember, when you write down the main characteristics of any market structure, start from those 4 characteristics we discussed last day, right? 4 dimensions. Okay, after 4 dimensions, you can jump into other main other sub, or we can say other characteristics, right? Start from first one, number of sellers, then nature of product, right? Those 4 markets, four dimensions are common for any market, right? Okay, here's the note, Huda, that I'm going to complete. I'll use my whiteboard. It's better for me. Okay, the lamai, right? Characteristics. Characteristics of a perfectly competitive market. Perfectly competitive market. Okay, the lamai, write down first one. Buddha, in the perfectly competitive market, there are large number of sellers. There are large number of sellers in the market. Best example, paddy market in Sri Lanka, Buddha. How many paddy farmers in Sri Lanka? I'm not talking about rice market, Buddha. Rice market belongs to another market structure. I'm talking about paddy. Paddy and rice different. The rice is made paddy, but different markets. Paddy market belongs to perfect competition market, Buddha. Egg, right, and vegetables, these market belong to perfectly competitive market structures. The main component, main characteristics of perfectly competitive market is there are large number of sellers now. Okay, the large number of sellers in the market, right? Okay, write down first one, Buddha, a very large number of a very large number of large number of large number of sellers, large number of sellers, large number of sellers, or you can say, and Putha, you can say large number of sellers and buyers, both. Okay, buyers also, large number of buyers in the market, right? Here my main focus is on sellers, Putha, right? Large number of sellers in the market, large number of sellers in the market, large number of sellers in the market, large number of sellers in the market. Okay, the lamai. Here the important point is, Pudha, remember, if there are large number of sellers in the market, no one has, significant market power. That is the important point here, right? If there are large number of sellers in the market, Pudha, no seller has significant market power or market share. In other words, Pudha, one single firm can't influence the market price and quantity. You get what I say? Okay, the lamai. A simple meaning of supply of one firm is insignificant. But when it comes to oligopoly market, lamai, oligopolistic market, entire market is dominated by few firms. Right? Example, let's say telecommunication market in Sri Lanka, lamai. Or soft drinks, cool soft drink market in Sri Lanka, dominated by Coca-Cola and Elephant House, Pepsi might be. Okay, the lamai. So one firm has significant market share. Example, Elephant House now. Elephant House in Sri Lankan cool drink market, soft bottle soft drink market, Coca-Cola or Elephant House, both these firms have significant market share. They can influence the market price. They can influence the market supply because their power, their market share. But when it comes to a perfectly competitive market, Buddha, no one has significant market power, resulting insignificant supply or no any influence on market price or market quantity. Did you get what I said, Kalana?
Yes, sir.
Okay, right. Second characteristics, write down, Lamai. Nature of product, write down homogeneous product. This is the word, homogeneous. Homogeneous, or we say Buddha, identical. Homogeneous or identical. Homogeneous or identical product. Within bracket, write down Buddha, homogeneous mean, write down, all products are close substitutes, Lamai. All products are close or perfect substitutes. Close or perfect substitutes. Close or perfect substitutes. Close or perfect substitutes. I think it's better to read the explanations of every character as well, Lamai. Look at page number 5. I'll go through those. Look at page number 5, Buddha. I have given you explanation for each and every characteristics of perfectly competitive market, right? Shall we go there? Okay, Dalamai. Look at first one. There are many sellers and buyers in the market. Can you read this point? There are many sellers in the perfectly competitive market. It is not possible. Highlight this point, Buddha. It is not possible for a single firm to influence the supply in the market as they too small, Lamai. Supply of one firm is too small, insignificant. That is the word we use, insignificant, right? In comparison to entire market. So one firm cannot influence the market price. One firm cannot influence the market price. This is the result of having large number of sellers in the market. So that in economics, we expect all markets to be perfectly competitive. Why? It's a good market to structure. No one has significant power. Okay, the Lamai. Every seller is insignificant in the market. Okay, the Lamai. But in practically, Buddha, it's very difficult for us to find perfect examples of perfectly competitive. Exits, perfectly competitive market, exits, but not 100%. We can't see these all characteristics that we are going to discuss. Okay, the Lamai. Highlight this point is really important. Comparison to it is not possible for single firm to influence the market supply or market price. Second one, Lamai, firms produce homogeneous product. What is mean by homogeneous? The homogeneous means simple idea is all are same. Color, shape, okay, the Lamai, quality, price. Example, Lamai, let's say fuel, petrol. Okay, the Lama. If you buy petrol from maybe Nuarelia or Gaul or Colombo, right? Wherever Buddha, everything is same, right? I mean, color, shape, quality, price even, Lama. Right? No any significant difference. There are no differences, Buddha. All are same. This is called homogeneous. This is called homogeneous, right? If you buy petrol from 10 petrol sets, and if I ask you to put them all to all these petrol that you have brought from 10 petrol sets into one basket, or one file of petrol, then Buddha, if I ask you now, pick that the petrol you bought from firm A, right? Pick up petrol from petrol you brought from firm B, then it's impossible, right? If you put all petrols into one basket, lama, you can't separate them, right? You can't separate them. This is from this Piliyandala petrol set. This petrol I got from Colombo. This from Kandy. It's very difficult. How can we separate them? All are same. Did you get what I said? Okay, the Lamai. So that is called homogeneous. But all products are same color. Read it. So that this is not from your professor's book, Professor Prasanna Pereira. Okay, the Lamai. All firms in the market produce identical produce what product? Identical goods where individual has no particular preference for a particular seller. You can buy vegetables from anywhere, lamai, right? All are same, right? Almost same, lamai. There can be small differences quality wise, but almost same, lamai, right? This implies that products of every firm are perfectly substitute. What is mean by perfectly substitute to them? If you can't buy petrol from Piliyandala, my Piliyandala said, or Colombo, wherever, you can buy it from another seller. No any preference, right? No any enthusiasm, no any, the motivation to buy petrol from one single or one particular seller. No. You can buy from any petrol set because all are same. No any particular difference. Okay, the Lamai. Then, what about tuition, Lama, in Sri Lanka? Our products is a service, same or different? Identical. The homogeneous mean all are same. The opposite of this word is heterogeneous, right? Or we can say differentiated. Products are different, but goods and services are different. What about tuition? Doctors, are they same, homogeneous, or differentiated? Alan, if you learn econ from me or from your school teacher, is service same or different for you? Same syllabus, same same paper, but I mean the service same or different? Yes,
It's different, sir.
different, Buddha. That is called differentiated. Very good. Dipna, tell me another example. Let's say Buddha, toothpaste. Signal, Glowguard, Sudanta, Supiriviki, Close Up. Tipna, tell me, are they all same? I mean, in terms of ingredients, price, color, especially that shape of the box, package, are they same or different, Dipna?
Different.
Different. So they are called differentiated or heterogeneous. Differentiated. That's why, Buddha, we have particular preference for one seller. We buy only Signal, right? We are loyal customers. We have been loyal customers of Signal or Close Up or whatever. We have a special preference for one seller, one particular product. In the perfectly competitive market, Buddha, no such a preference. You can buy vegetables or petrol, but remember that petrol market does not belong to perfectly competitive market, Lamai. I'm talking about only certain characteristic. Okay, the Lamai. But remember, even though products are homogeneous, you can't jump into the conclusion that this market is perfectly competitive. No. Okay, the Lamai. Even though second characteristics is fulfilled, Buddha, you can't say that market structure is perfectly competitive. No. I didn't say anything like that. Okay, lamai. This is one of the characteristics of perfectly competitive market, right? Okay. In terms of quality, quantity, quality, color, size, and any other features, there are no branding. Remember this word also, Buddha, this point also. In perfectly competitive market, no advertisement, no branding. But when it comes to more oligopoly, like toothpaste, shop, soft drinks, other, what else? Milk powder, my God. Okay, if you switch on your TV, Buddha, I think more than 80% of advertisement belong to, the oligopoly market structure, right? In this market structure, Buddha, no advertisement. Have you ever seen vegetable sellers, making advertisement to promote their products? Sandil? Alamai? No. Kalana, have you ever seen this petrol set, Sipetco, IOC making advertisement?
No.
No. Okay, Dalamai. Why? Why can't they make advertisement, Buddha? Why, don't they engage with branding advertisement as other firms do, other market structures do? Yes. Can anyone tell me why can't they, advertise their products? Why can't they make a brand for their products?
Because those are essentials.
Not essentials, Buddha. That is not the point. Sorry, yeah, good. I appreciate your answer, but that's not the point. The point is, Buddha, if you want to make advertisement for your product, right? Your product should be specific, Buddha, right? Your product should have something special other than your competitors. Did you get what I said?
Yes.
Okay. Example lamai, the signal or flow guard, or let's say the shop, the life boy බලන්න යා කොහොමද advertisement කරන්නේ ළමයි. යා ගොඩක් වෙලාට අර hygiene part එකට නේද ළමයි යන්නේ. Like they are very healthy and අර medical side එකට නේද ළමයි යා ගොඩක් වෙලාට focus කරන්නේ. The killing all germs are 100% Dettol. Okay ද ළමයි. But what about Lux? They mainly focus on fragrance and that ingredients. They say that they are the that shop is made of maybe whatever the flowers and different ingredients like my rose or flora whatever that they have something lamai. They try to say our product is different, so buy our one. This is the best one. But because their products are differentiated, different each other. Okay, Dalamai. But when it comes to perfectly competitive market, Kalana, all products are homogeneous. Then how can petrol sets make advertisement for petrol? How can they do that? Can they say our one is how to say that, right? They can't say our one is the quality one, the best quality product. Come and buy our one. No, because all products are same. Consumers know that. And also, Buddha, in this market structure, consumers are well informed. They know everything. Firms can't mislead them, right? Consumers cannot be cheated, Buddha. They know everything. Perfect information there, right? So remember, there are no branding, no advertisement in perfectly competitive market. The reason is, Lamai, products are homogeneous. All products are same. So how firms can make advertisement? Okay, the Lamai. Right. Then the following graph show how the equilibrium price is determined by perfectly competitive market. Lamai, I think this table should not be here. It should be in next page. Mistakenly, I have put this table here. Cut it off. Okay, the lamai. Right. Then Buddha, let's move into third main characteristics of perfectly competitive market. My third one, write down. Buddha, what is the main third dimensions of can you remember dimensions that we discussed last day? Ipna? Sorry, sellers, nature of the product. What about third one?
Barriers to enter
Barriers
and
to
exit.
entry and exit, Buddha, right? In the perfectly competitive market, Buddha, no barriers to entry. Anyone can come into the market anytime. Write down. No barriers to enter. No barriers to enter. No barriers to enter or exit. Exit from the market. From the market. Okay, the Buddha. No barriers to enter or exit from the market. Buddha, barrier mean anything which restricts new firm come into the market. It can be technical barriers, legal barriers, or lower cost of existing firms. That is called economies of scale or the natural monopoly. Sometimes it may be artificial barriers. Existing firms create, strong barriers, very, strong net, that net, safety net, which restricts new firms come into the market. In this market structure, Buddha, no barriers, no legal barriers, no, I mean, especially no big amount of capital is required at the beginning, right? So no barriers to entry and also from exit the market. Now, what is mean by exit barriers? Example, Buddha, if you start a business by investing a huge capital, assume 5 million, 10 million, let's say food city, okay, small food city, okay, starting that food city by investing the huge amount of capital, like assume Buddha 5 million, then even though you can't reach that desired or expected profit level, you can't leave the industry because you have invested a big amount, right? You can't, mobile, that is a word, you can't mobile or shift that resources that you have invested on food city into another industry easily. So you try to exit in the market, you try to stay in the market even though you are making losses. Exit, right? It means maybe especially with the technological investment. In some markets, with the firms have to invest huge amount of capital on technology, especially to start up the business, set up the business. So even though they can't reach the expected profit level, it's very difficult for them to leave the market. Okay, Dalaman, because of high investment they have done. Did you get what I said? But in perfectly competitive market, Buddha, no barriers. If you want to go into the market, Buddha, you can go, no barriers. If you want to exit or leave the market, no barriers. The main thing is, Buddha, here, no, I mean, when you start the business in a perfectly competitive market, Buddha, the no big amount of capital required. So when you don't, if you feel that this market structure not for me, right? I'm not performing well in this market structure. I have been making losses, so I need to leave the market. No barriers, Buddha. No, you can leave the market because you have invested very small amount of money. Okay, the Lama. Just imagine Buddha paddy. Okay, if paddy cultivation is not profitable enough, Buddha, the farmers can move into another maybe potato cultivation. They can quickly, right, shift their resources, right, move or take resources from that industry to another cultivation or another industry. Okay, the lamai. That is called barriers to no barriers to enter or exit from the market. Are you okay with this? So this is very very simple market structure, Karan. If you want to start a business with that, you can start off from here. This is the best market structure. Not best, I would say easy, right? Okay, then shall we read the third one? No barriers to entry. The description of third point. Right. Could I read the third point? There are no barriers to entry or exit from the market. Read it. Another characteristics of perfectly competitive market is that new firms can enter into industry mean market without any disturbance. This means barrier. And existing firms have the ability to freely leave the industry, no barriers. Any entrepreneur can enter into the industry by freely, remember this word, freely mobilizing resources, and there are no barriers that limit the freedom to exit from the industry. There are no regulations and laws which prevent free entry to the industry, such as need to obtain license, patent rights in an industry. No license, no patent. If you want, you can enter into the market or industry with very small amount of capital. Okay, the lamai. Right. So the freely mobilizing mean, assume paddy, potato, paddy and potato. Assume the farmer is in the paddy industry, is not making the desired profit level, expected profit level, right? Anyway, Buddha, the paddy farmer has invested money and other equipment in paddy industry. Then if he feels that this is not profitable for me, right? The paddy cultivation is not profitable enough for me. The farmer is able to move, or the mobile resources invested in paddy cultivation to potato cultivation easily, Laman. That is the idea. Mobilizing, freely mobilizing resources. Freely mobilizing resources. Okay, the Laman. Uday, you might have seen some street vendors, right? The people selling something, right? Special, maybe vegetables, fruits, and toys, plastic items. Okay, the Laman. Maybe in the town or along the road, the side of the road, they one day they sell vegetables. If they feel selling vegetables is not profitable enough for them, next day Buddha, they sell something else, toys or plastic items or something. Why? No barriers to entry and also exit. If they feel they are not, the profit is not enough for them, they can jump into another industry by mobilizing resources to that industry easily, no barriers. Okay, the Lamai. Right. Are you okay with this? Any problem? Kalana, Dipna?
No, sir.
No. Right. Third one done. Then put the fourth one. Write down fourth main characteristic of perfectly competitive market is gone lamai, right? Anyway, fourth one, is perfect information lamai. Write down press fourth one, perfect information. Fourth characteristic is perfect information. No barriers to entry. Fourth one lamai, write down perfect information. Perfect information. Perfect information. Perfect information. Within bracket, write down to the all buyers and sellers. All buyers and sellers. Buyers and sellers possess. All buyers and sellers possess market information. Perfect market information. Perfect market. It's mean Buddha, they have everything. Consumers and producers, especially sellers, are well informed. No one can mislead them. Okay, no one can cheat them. Well informed Buddha, right? Price, and let's talk about sellers Buddha, right? They know, the prices and technologies, especially the used in the industry. Okay, the lamai. And how to make the product properly. Okay, and production technologies, everything is available, no hidden information, everything perfectly available now. That is called perfect here we say Buddha, the consumers are well informed, they know everything. Perfect information. Fourth one, can you read the fourth point, the description of fourth point? Fourth one, no barriers to entry exit. Okay, perfect information now. Read it. There is perfect knowledge. Perfect knowledge. Perfect knowledge with no information failure or the time lag in right in the flow of information, and knowledge are freely available now. Freely available. So if you have any doubt, please let me know. Freely available to all participants in the perfectly competitive market. Each and every participant in a perfectly competitive market understand correctly what is happening in the market and make accurate decisions. Example, when vegetable prices decrease, everyone knows that, right? Now, if one seller is trying to sell vegetables at a higher expensive prices, we can say, මාර ලාබයින මේ දවස්සල මේ නේද කියන්න පුළුවන් මේවා මාර ලාබයි වා මාර ගානක් ගන්න හදන්න. එහෙම අර අපිට කියන්න පුළුවන් ළමයි. Clearද? Well informed. Okay, the ළමයි. When vegetable prices increase due to this, cyclone or due to this adverse weather condition, we know that our vegetable prices are really expensive now. Okay, these days with the fish prices really expensive due to this the weather condition. Okay, the llama. Then what everyone knows that what is actually happening in the market, right? No secrets, right? Make accurate decisions. Firms that are already in the industry and firms that wish to enter into the industry have perfect information now. Perfect information regarding demand, supply, price, profitability, production cost, and technology. Right? Well informed. Both consumers and producers are well informed. Okay, the lamai, right? 4 main characteristics done. Then if you ask to write 4 main characteristics of perfectly competition market, what would you say, Buddha? Number 1, large number of sellers in the market. Nature of the product. Buddha, what is the nature of the product in the perfectly competitive market? Are they same or differentiated? Yes, homogeneous product, no barriers to entry and exit. Okay, Sandil. Then put the perfect information there. These are the 4 main characteristics of perfectly competitive market. Okay, the Lamai. Right. Then put the other than these 4 characteristics, we can identify some other characteristics as well. Okay, right. What is fifth one? Fifth one is it's given, Lamai. Perfect mobility of resources, as I told you. Producers, so the firms in the perfectly competitive market are able to shift, or we can say take resources from one industry where the sufficient profit is not made, to another industry where the producers feel that they can earn profit. Okay, the Lamai, or unprofitable industry to profitable industry. Perfect mobility of resources. This is fifth one. Sixth one, Lamai. No single buyer or seller can influence the ruling market price. This means that one single firm is not able to change the market price by their own action. Example, insignificant market power of a single firm. This is called the price taking behavior. I'll explain this point in detail. Right. Shall we discuss this point? I think it's very important point. Look at this point, page number. No barriers to entry. Right. Firm is considered as a price taker, Slama. Firm is considered as a price taker. Firm is considered as a price taker. So that there are two. Give me 1 minute. Right. So that some firms are price makers. Price maker. Price maker means simple idea, Lamai. Others are price takers. Others are price takers. So the price makers mean they can decide their own product price rather than depending on market price. I mean market price which is determined by market demand and supply forces. Right? Example, my sunlight. They have printed and given their price on that box, or that cover of sunlight shop. Okay, the Lamai. This is the price. They can decide their own price for their product. That is called price maker. Okay, the Lamai. Price maker mean price making behavior mean the ability. If you want this, write it down. Ability to set own price. Ability to set own price. Okay, the Lamai. Right? Ability to own price rather than rather than passively depending on market price. Okay, the lama example buta in my classes I can decide price. Okay, the lama I would say, okay, this is something, maybe as there are, less than 10 students, this is the class, and class fees. So the individual attention is given. This is something special, not like a mass class. This is the price. So I am a price maker. Okay, the lamai. Doctors puta, they can decide their charge. Okay, the puta, after the after that writing the prescription, doctors say this is the price. When you ask how much, doctor, price is 2,500. This is for pharmacy. Okay, the lama, you can take this medicine from pharmacy. This is my price. They can decide their price. These are called price makers. Lama. Price makers. Price makers. Okay, the lamai. Price taker mean important one is that they can't decide their own price. They have to accept the prevailing market price, which has been determined by market demand and supply. Okay, the lamai. Price taker mean firm is not able. Firm is not able to set its own price. Lamai. Its own price. Its own price, it has to accept the prevailing market price. Lama. Prevailing market price, which is determined by demand and supply forces. Demand and supply forces. Demand and supply forces. Okay, best example with the vegetable sellers. Assume with the you're producing carrot or potato or something. Can you say that you know I tried my best to produce this bags of carrot, so I'm going to sell my 1 unit of carrot, 1 kilo of carrot for 600 rupees, not less than that. My price is 600. If you want, you can buy, otherwise you can go. Can you say that? Carrot sellers, farmers, can they decide their own price? Can farmers say no, this is the cost of production of producing one single unit of paddy, right? I have to spend 100 rupees to produce this paddy unit, so I need 40 rupees profit per unit, then my selling price would be 140. I'm going to sell my paddy at 140 rupees. Can farmers sell like that, Sandhi? Yes, Lamai? No. They can't say that. They have to accept the prevailing market price. But if market price is 50 rupees, they have to sell entire stock at 50 rupees. That is called price takers. Price makers, price takers. First one is called price making behavior. Second one is called price taking behavior. So the firms in the perfectly competitive market are called price takers. It means they can't decide their own market price. They have to accept the prevailing market price, which is set by or determined by market demand and supply. You get what I said? Alana? Ipna?
Yes, sir.
Yes, sir.
Okay, the Lamai. Right.
Excuse me, sir.
Yes, Daru.
Sir, the body is shiny. Can you repeat the first part of the price taker's definition?
Here, Buddha, the firm is not able to.
Okay, sir.
Firm is not. Buddha, use a sticky note. I think there's no separate place to write this down. The firm is not able to. The firm is not able to set its own price. It has to accept the prevailing market price, which is determined by demand and supply forces. My handwriting is a bit ugly, Lama. If you have any problem, please, if you have an unclear point for that, please let me know. Alana, tell me, Buddha, do you like to be a price taker or price maker? If you're doing, I mean, if you do business, assume if you want to be a businessman, Buddha, right? Or if you have your own business, imagine, would you like to be price maker or price taker?
Price maker.
Price maker. But that depends on the market structure, Lama. Okay. If you operate in the perfectly competitive market, Sandil, you don't have options with that. You have to accept the prevailing market price. Can you remember that equilibrium price? Demand and supply forces, meet at one point and, determining one price, one quantity, that price has to be accepted by the firm in the perfectly competitive market, whether that firm does likes or not. Okay, the Lama. A firm is not able to set its own price. It has to accept the prevailing market price, which is determined by demand and supply forces. Market demand and supply. Price taking behavior and price making behavior. Let me know once you are done.
Done, sir.
Okay. Kalana, Sandil.
Done, sir.
Okay. Right. Then for the graph. Look at the board. Yeah. Look at the board. This board is it's shining near the Lama. Right. Lama, this is the market. Market. But I want every one of you to concentrate on what I'm talking. This is really important point. Really important point. Okay. I've seen so many past paper questions from this part. Okay. Right. Market, a firm. I'm talking about perfectly competitive market and firm. Okay, the Lama. With a perfectly competitive market, the normal market, Lama, where demand and supply operate. This is market demand. DM mean market demand. This is market supply. So that this is the entire demand and supply. It's not talking about one firm. Don't get me wrong. This market demand shows the entire. Can you remember individual demand and market demand? This is market demand, right? The number of units that all consumers are willing and able to buy at different market prices. This is market supply, right? The entire supply, or we can say the number of units that all sellers are willing and able to produce or sell at different market prices, different prices. Kalana, what is this? The point, intersecting point, what is this?
Market equilibrium.
Equilibrium. You are expert in this lesson, Buddha. This is market equilibrium, price and quantity. Assume, Buddha, this paddy market P1 price. Assume, Buddha, price is 100 rupees. Price is 100 rupees. Price of one paddy unit is 100 rupees. I don't know why this board. Board is a bit unclear, isn't it, Buddha?
Yes, sir.
Yes.
Right. Okay. We'll see. 100 rupees. Assume Buddha equilibrium quantity is 1000 units. Then Buddha, when it comes to one firm has to accept the market price which has been determined by market demand and supply process. Did you get what I said? Then Buddha, this is individual firms demand and supply. This is price, this is quantity. Okay, the Lamai. Then Buddha, if this farm uncle has, let's say, 1,000 kilos of paddy, farmer uncle can sell entire quantity he has at 100 rupees, Lamai. It means this market price. It means Buddha, the farmer uncle has to accept the price 100 rupees. It means that the farmer uncle can, sell any amount of quantity at 100 rupees. Whether it might be 1000 units or 2000 units, doesn't matter whether it's 3000 units, whatever quantity that farm uncle has can be sold for 100, I mean at 100 rupees. 1 unit 100 rupees. So that this is the demand curve of one single firm. Demand curve of one single firm. This is not supply curve. This is demand curve. Okay, the Lamai. Perfectly competitive firm supply curve comes like this. Marginal cost curve. Right, I'll explain that point. Don't worry. This is a demand curve, Lamai. Right. Right. So this is called Lamai. Oh my God. Demand curve of one single firm. One single firm. This is firm's demand curve. This is market demand and supply curve. Okay, the Lamai. This is the price determination of perfectly competitive firm. Market demand and supply forces determine or set the market price 100 rupees. Firm has to accept the market price, prevailing market price. Okay, the Lamai. Example, just imagine due to a good harvesting time period, Lamai, the market supply increases. Kalana, tell me, if market supply increases, what happens to supply curve?
Shift to the right side.
Shift to the right side, Lamai. Then if it shift to the right side, what happens to market price?
Decrease.
Decrease. Then assume that due to increase in supply, market price falls to 80 rupees. Then this seller, farm uncle, has to sell entire stock at 80 rupees now. See how unlucky they are. Okay, the Lamai. When market price changes, they don't have any options for that. They have to accept the market price. You get what I said? So this is called price taking behavior. Listen, this point is really important. Lamai, if a firm is a price taker, firm faces perfectly elastic demand curve. Okay, Lamai. I'll repeat. If firm is a price taker, it means if firm has to accept the prevailing market price, which is determined by market demand and supply forces, that firm faces perfectly elastic demand curve. Can you remember this shape? This is called perfectly elastic. Perfectly elastic demand curve. Perfectly elastic. Idea is, firm cannot influence the market price. firm can sell any amount of quantity at prevailing market price. So that the same demand curve, same demand curve applied for the world market. Example, international trade. In international trade, in the world market, especially world crude oil market, Sri Lanka is very small supplier. Sri Lanka is very small, insignificant supplier. We can import any amount of quantity from world market at prevailing market price. Okay, Dalamai. Can you remember something that supply curve of imported goods that we discussed in protectionism, tariff and all? Okay, Dalamai. Normally, the supply curve of imported goods is perfectly elastic. The reason is, Buddha, we are very small or insignificant buyers in the world market, so we can't influence the market price, but we can buy any amount of quantity from the world market at prevailing market price. Okay, Dalamai. I'm explaining the behavior of this perfectly elastic demand curve. Yes. Can you write this down, Buddha? I think, Buddha, that I ask you to cut off one, two tables, Buddha. Where to write this? Buddha, page number 6. Page number 6. At end of the page, there are 3 dotted lines. After the dotted lines, below the dotted lines, you can draw this. Page number 6. Okay, Dalamai. Did you get what I'm saying? Page number 6. There are 3 dotted lines. There are 3 dotted lines. Below the dotted lines, Buddha, draw these 2 diagrams, small way. Right? If you feel that is not enough, you can use a sticky note or I don't know. But anyway, it should be placed. I mean, whatever paper you use should be placed here. I mean, in page number 6. Otherwise, you will forget that this part. Okay, right. I need more time. Shall we move on?
Finish, sir.
Okay. Dipna, Sandil.
Done, sir.
Okay, right. Next, Pudha, then come to the page number. Yeah. Firm is considered as a price taker. Shall we read that note? Right. Look at the board. Firm is considered as price takers. Yes. A price taker. A price taker is an individual or company that must accept prevailing prices in a market lacking the market share. It means their market share or the market power is not enough. Okay, the lama, it's not enough or not strong enough to set their own price. Share to influence the market price of its own. All firms in the perfectly competitive firms market are considered price takers. That is, price taking behavior and making behavior can be explained using this theory point as well. So if one single firm in the market, any market structure, can change the market price, increase or decrease, by changing its supply. By changing its supply, that is called price maker. Right? You know that when supply increase, lamai, market price falls, right? If individual firm can increase the market price by decreasing supply, that firm has price making behavior. But when it comes to perfectly competitive market, Buddha, by changing individual firm supply, they can't change the market supply. I mean, they are price takers. I think got the point. Okay, Dalaman. Simply, firm in a perfectly competitive market cannot decide their product price, and firms have to accept prevailing market price determined by demand and supply. It should be market demand and supply. That is called price taker. Then Pudha, firm in a perfectly competitive market is considered as a price taker because what are the reasons? It's a really important point. Why can't they decide their own price? Yes. Why farm uncle is not able to set his own price for his paddy? Why a firm in a perfectly competitive market is not able to set its own price? Kalana, now you know the reasons for that. You know some reasons, yes. Number one,
Number of firms.
large number of firms, or you can say the insignificant market power or insignificant supply, right? As one firm has very small, or we can say insignificant supply in the market, Buddha, they can't influence the market price. What else? Buddha, why can I decide my, class fees for my tuition classes? Why can I decide my own price? Where I get that advantage from? Very good. Uniqueness. Okay, Dalamai. Pudha, remember, if product is very good, Sandil, if product is differentiated, Sandil, am I unique? Send it to common or yes. What is the uniqueness? Happy to hear. Deep. Thank you. Okay. Thank you very much. Right. Anyway, a firm in a perfectly competitive market is considered as a price taker because number one, yes, as Kalana said, price take. Sorry, insignificant supply. Then for the if product is differentiated, for the firms can charge different prices. Okay, the lamai. Example, another example we can say lamai salons, beauty salons. Dipna, have you ever gone to coloring hair and facials, what maybe other treatments? Okay, the lamai. They have something uniqueness, right? Every firm tries to give a unique service, differentiated service, and they charge different price. This is our service, we are different from others, right? And also sometimes they say we have very specific customer group, right? So this is our price. But if you can make your product different, you can make your product different from your competitor's product. If you offer something else to something different or something unique to your uh, customers, you can charge a different price. But when it comes to more perfectly competitive market, Kalana, are product differentiated or are products different or homogeneous or are all same?
Homogeneous.
Homogeneous, then how can they charge a different price? Because all the same. Then how what can they say, Buddha? Can vegetable sellers say paddy farmers sell this my product is quality, my product is this is bigger than size bigger than other farmers, right? My color is different, that's why I'm charging a different price. No, Lama, they can't charge because all products are homogeneous. That's another point. Insignificant supply, product is homogeneous. There's a one more. What is the other one? Then Buddha, in my example, a farm uncle cannot charge a price more than 100 because market price is 100 rupees. Farm uncle cannot sell his products more than 100 rupees. Why? There's one more reason, Buddha. There are three reasons. Out of three, one is main, but there are three. What is the other one? Can anyone guess? Example, Buddha, in petrol or gas, petrol especially, fuel. In Sri Lanka, Buddha, one seller sells now one petrol liter is 434 rupees. If one seller sells one petrol liter at 500 rupees, Buddha, can that petrol sets do that? The reason is Buddha, consumers are well informed. You can't charge a different price, they know everything. Okay, the third point was the perfect information. Right? You can't charge a higher price because consumers know that they know exactly, they know what is actually happening in the market. Right? The price that other sellers are charging in the market. So you, one single firm, is not able to charge a different or higher price. Because consumers, that's why I told you at the beginning, consumers cannot be cheated, right? Firms cannot mislead consumers as they are well informed. You get what I said, Kalana? Ipna?
Yes, sir.
Okay. Write down, Buddha. There are 3 reasons. First one. First one. Write down. Actually, Buddha, the first reason. First reason. I'll explain this point in detail in next month. Other market structures, Buddha, especially a monopolistic competition. This price taking behavior, of a perfectly competitive market basically comes from uniqueness of the product. Okay, the Lama. That should be the number one. Okay, the Lama. Right. First one, write down. You not here, not the uniqueness, homogeneous of product. Write down. First reason we can say Buddha, homogeneous product. Homogeneous. Homogeneous product. The product is homogeneous. Or we can say product is identical. Product is identical. Second one, Lamai. Second one, we can say Lamai, insignificant market supply. This is one. Insignificant market supply. This is first one. Second one, insignificant. Market supply. Or we can say about the lack of market power. That one also. Or lack of market power. Third one, as you said, third one is no, I said it. Perfect information. Perfect information. Perfect. These are the 3 reasons. These are the 3 reasons for perfectly competitive firm to be a price taker. So I would say this is the main one. No any argument. This is the main one. As products are identical, they can't charge a different price. This is the number one. Number one. Remember this point. Others are also okay, but first one is nature of the product. This price making taking behavior comes from the nature of the product. If it is differentiated one, you can charge. I mean, they can charge different price. If product is homogeneous, they have to charge the market price. Shall we move on? Yes.
Okay.
Okay. Right. Okay, Lama. This point, or this is the last point of that. The point that I'm going to explain is the last point of perfectly competitive market. That's really important, Lama. MR, AR, and TR. Right. Revenue concepts. Revenue concepts. Right. There are 3 revenue concepts, Lama. There are 3 revenue concepts. 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 So the first one, total revenue. TR. TR mean total revenue. The very simple total revenue mean, we have already discussed this point with the total revenue mean, the total income. Total income which is earned by a firm selling goods and services in the market. Total revenue. How to calculate total revenue? Price into quantity, P into Q. Okay, the lamai. Second concept is for the average revenue. Average revenue. Average revenue mean for the income per unit, right? Average income or the income earned per unit of output, right? How to calculate average value? Simple. TR over quantity. This is a way of, if you want to calculate average value, anyway, whatever amount, the top should be divided by the quantity, TR over Q. Then there's another concept, marginal revenue. Marginal revenue. Marginal revenue, marginal revenue, that is called MR, marginal revenue. Right. Marginal revenue, that is third one is marginal revenue, MR. What is third one? MR. Concept is marginal revenue. Marginal. So how to calculate marginal value? If you are given word, the letter M, marginal value, Kalana, how to calculate marginal value, Lamai?
Change in total revenue
Over change in Q. Remember, Buddha, if you want to calculate marginal value in economics, take the difference, right? Marginal value is calculated with the delta change in TR over change in quantity. Change in TR over change in. This is marginal revenue. Okay, these are the three revenue concepts. Okay, right. But in perfectly competitive market, we have to discuss how these three concepts behave. How the behavior of TR, how does AR behave when output changes, and how MR changes. Okay, next. Right, Buddha, you can read these definitions and all total revenue, you know what it is. No need to waste time. Total revenue is the revenue that can be earned by selling certain number of units at a given price. Okay, the TR equals P into Q. No problem, Lamai. Right. Second one, TR, okay. Second one is for the average revenue. Page number, what is the page number? Page number 7. Average revenue. Average revenue definition is for the average revenue means refers to revenue received by selling 1 unit of output at any given point. Write down the equation, Buddha. Average revenue equals average revenue equals total revenue over we can say output, number of output. Okay, my equation is AR equals TR over quantity. TR over quantity. Shall we move on, Lamai? That?
Done, sir.
Okay. Lipna, I hope have completed.
Done, sir.
Oh, right. Okay. Then lamai, last one is marginal revenue. Marginal revenue. You know the idea of marginal revenue, right? Marginal revenue means change in total revenue as a result of increase in output by 1 unit. Okay, if firm adds 1 unit of output to the total output with the by how much total revenue changes. That is the idea of marginal. Look at this, marginal revenue is the additional or incremental revenue a firm would earn if it sold 1 unit of output. Right? The marginal revenue is represented through the slope of total revenue curve. Yeah, you can write down the equation. Write down marginal revenue equals marginal revenue equals marginal marginal revenue equals total revenue. Sorry, change in total revenue. Change in total revenue. Change in total revenue over change in quantity, or we can say change in quantity or output. Quantity or output. Equation lamai, write down MR equals marginal revenue equals change in total revenue over change. Simple idea Buddha, marginal revenue is the change in total revenue due to an increase in output or quantity sold by 1 unit. That is a simple idea. By how much total revenue changes, as a result of an increase in output by 1 unit. That is the idea of marginal revenue. It's the same like marginal cost. Change in total cost due to increase in output by 1 unit. All about revenue. Total revenue. Shall we move on? I'm hurry to complete these 3 curves as well. Then lesson is done to the completed. Let me know once you are done.
Done, sir.
Alana, Sandil,
Done, sir.
right. Then Buddha, you can complete this table. I'm not going to help you. I'm not going to give any help. I want you to complete this table. Okay, Dalamai. Complete this table first. Then Buddha, you can draw TR curve. Here TR, quantity and TR, total revenue. Here, quantity, AR, MR on one diagram. AR, MR. Output, here total revenue, here MR and AR. Okay, Dalam. Right. This is for you. Let's do it, Lamai. Demand, price, total revenue, marginal revenue, and average. Page number 8. Quantity given lamai, quantity, price, TR, total revenue, marginal revenue, MR, and average revenue. Quantity given lamai 0, 20, 40, 60, 80, 100. Right. Quantity 0, price 20. Now how to calculate total revenue? Total revenue equals price into Q. MR, change in total revenue over change in quantity. AR, TR over Q. Okay, right. Here with the TR equals 0. Here no MR, no AR. Alana, tell me, this is one firm, Buddha, right? Don't get me wrong. This is the one firm's total revenue, MR, marginal revenue, and average revenue. Buddha, can you tell me how much the selling price of this product here? I mean, my next question is, at which price can this firm sell 20 units? What is the price here?
Quantity.
No, sorry, what did you say?
Nothing, sir.
How much the price here? Sandil? 0 units. If firm is selling nothing, market price is 20 rupees. My next question, when they selling 20 units, how much the market price? How much market price be? Or next question, another different way of asking that. Can they sell these 20 units at 30 rupees? No. They have to sell the entire quantity. Can you remember that? They have to sell whatever quantity at prevailing market price. Prevailing market price is 20 rupees. You're given. Right? Whatever quantity they sell, Buddha, maybe 100. Quantity doesn't matter. They have to sell entire quantity. Whatever they produce at prevailing market price means 20. Can you remember that price taking behavior? If market price is 20 Buddha, they have to sell whatever quantity they produce, or 40 or 60 or whatever, price is 20 rupees now. Did you get what I said? So here market price is 20 rupees. For whatever quantity lama, any quantity, market price should be 20 rupees. Okay, lama, that is called price taker. No, Sandil, price taker. Constant at every point, yes. At every quantity, price same. They can sell any amount of quantity at prevailing market price now. Okay, the lama 20. Right, total revenue 20 into 20, 400. 14 to 80, 800, 1200, 1600, 2000. This is the total revenue. So the marginal revenue is calculated. Marginal revenue is calculated. Change in total revenue. Change in total revenue 400 divided by change in quantity lamai, not change. This one, change in quantity. Yeah? Here, change in quantity, change in Q is 20. Then put up 400 over 20. How much the value? Sandeep. $400 over 20. Hello? Can't you hear me, Sandeep? A question. No, question is with the how much the marginal revenue. Change in total revenue is 400 over change in quantity. That is a way of calculating marginal revenue. Ipna, how much the value put up? Marginal revenue. MR equals
20.
yes, Buddha. Change in TR over change in Q. Here, change in TR, Sandeep, how much? 400. 400. Gap is 400 over change in quantity. Change in quantity is 20 units, right? 20 units. Then marginal revenue should be 20. Okay, the Laman. So here, marginal revenue, remember it should be placed in between two values. Marginal revenue should be 20. Right? Then next one, change in total revenue over change in quantity. You can see when moving from 400 to 800, put that total revenue changes by 400. This 400 has been caused by increase in output by 20 units. So change in output again 20. 400 over 20 means 20. So here the marginal revenue does not change. Marginal revenue everywhere it's 20, 20, 20. You get what I said? Marginal revenue is 20. Average revenue, how to calculate average revenue? Here no average revenue, then average revenue equals TR over Q. Here put the TR 400, 400 over 20. Quantity, 400 over 20 means 20 rupees. Average revenue is 20. Here at 800 revenue, 8 to TR 800 at 40 units. Then 800 over 40. Ipna, how much the value?
20.
Again 20 Lama. 20. Then at 60 units, firm is making 1200 revenue. And how to calculate average revenue? Revenue per unit. 1200 revenue is made by 60 units. Then 1200 over 60. Again 20 Lama. Right? It also doesn't change. This is the behavior of AR, MR, and TR. $20. So that let me know once you are done. If not able done or need more time.
Done, sir.
Okay, then you can draw the diagram. Sandil, if you don't have a tube Buddha, you can use your writing book. Draw it yourself Buddha, then yourself, you do realize, this is the shape of TR, right? Alana?
Done, sir.
Done. Then you can draw the diagram, the TR diagram, total revenue diagram. The quantity changes 20 by 20, 20, 40, 20, 40, 60, 80, 100. This is quantity. TR, look at values of TR with a 400, 800, 400, 400, 800, 1200, 1600, and okay, the my first one at 0 output with that TR also 0, doesn't change. Zero. At 200 output dipna TR all 400. Sorry, at 20 output TR 400. At 40 output TR 800. At 60 level of output for TR 1200. This is the shape of TR curve. This is total revenue curve of perfectly competitive firm. Don't forget that part. Okay, the number. Then you can draw the marginal and average together. Nothing to draw, it's very simple, right? Quantity and here AR and MR. Average revenue and margin. 0. Quantity 20 by 20 lamai 20, 40, 60, 80, 100. Marginal revenue, average revenue 24. I think it doesn't change lamai, so it's 20 rupees. In 20, at 20 units with the marginal revenue and average revenue same 20. 40 units again it's 20. Both are 20 Buddha. No change. 20. What is this? This is called marginal revenue curve or average revenue curve or demand curve. Can you remember the demand curve of one firm? Also that perfectly elastic shape. Then Buddha, we can make a conclusion in a perfectly competitive market, a perfectly competitive firms, average revenue, marginal revenue, and demand curve and price all same lamai. Price also 20 rupees lamai. Remember this relationship. Okay, the number. This is ARMR. This is total revenue. MRAR and total revenue. Let me know once you're done. Then put here total revenue curve. Total revenue curve is upward sloping curve. Quantity, total revenue 0. Total revenue curve is a normal upward sloping curve starting from origin. Starting from origin. Okay, the lama. Marginal and average revenue curves. Quantity, AR and MR. So parallel to the price axis, sorry, quantity axis. Parallel to the quantity axis, this is MR, AR, demand curve and price of the. So let me know once you are done. Graph.
Done, sir.
Done. Kalana, Sandeep.
Done, sir.
Okay, good. Any problem, Huda? I think it's very clear. Okay, now you know everything. Okay, then now Buddha, this point is okay. This point. This one, Lamai. Now this is, you're clear with this point. No single buyer or seller can influence the market price. Insignificant market power for this is called price taking behavior, and average revenue, marginal revenue and demand curve all same. Okay, the lama. All same. Right. Okay, Lamai, that's enough today. See you next day, Wednesday. This week we'll be doing the class. Same graph for every firm. Yes, this is firm's behavior. Okay, the Lamai. Right. Okay, Buddha, I'll be doing past papers of perfectly. I have single firm to explain this in the long run equilibrium. They earn normal profit. I'll explain that point on Wednesday class. And Buddha, I'll do past papers from this part. There are some theory questions, Buddha. Essay question, past papers from this perfectly competitive market. MR curve, Sandil, MR, AR both drawn at the same diagram. This is TR, this is MR. Right, okay, Buddha, that's enough today. See you next day. Thank you for coming. Bye.
Thank you, sir.
Thank you, sir.
Bye-bye.